If you really stop and think about it, you finance every single thing you buy. Either you pay interest to a banker, like a car loan or a credit card or a mortgage, or you save up and pay cash and you pass up the interest you could have earned on the money had you left that money in your bank account or brokerage account and left it to invest and grow instead. So we're either paying interest to the banker for past purchases, or we're stealing interest from our future selves. We're financing it from our future. Like a $50,000 vehicle today might be $200,000 of lost opportunity cost by the time I'm 65 or 70, depending on rates of return and all that. Mm-hmm. That's a that's a tragedy if you think about how many stinking cars we're going to buy in our lifetime.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today, I'm joined by Mark Willis, CFP, and yes, that's Certified Financial Planner. He's a best-selling author and host of Not Your Average Financial Podcast. Mark is challenging traditional wealth-building strategies and introducing physicians and investors to the bank on yourself concept. It's a strategy for financing your own investments, escaping the cycle of debt, and building tax-free wealth. Here we go. The crowd cheers and we open up, and Mark is on the show with us. Mark, how does it feel to be Mr. Mark Willis today?
Right now, slightly squishy on the back of my chair here, but otherwise I'm feeling in great shape. I was just reading the other day that the healthy man has 1,000 goals, but the unhealthy man only has one goal. And so thank God I'm feeling good, healthy, and I've got about 1,000 goals.
The challenge with that, with the 1,000 goals, and I heard Elon Musk say the other day that somebody asked him what it was like, what goes on inside your head? And he said, it's a storm. And when I heard that, it's like some people can be amazed or dislike, politics aside, it was almost depressing, because if you would imagine it's just storm in your mind all the time, you've got 1,000 goals. How in the world do you keep all of this straight and still have family time? And if you let the stress roll in on you, then you're just in trouble, and it creates all these bad things. So staying focused is important. And if there's focus in the squishiness, then there's some happiness in there, right?
That's right. Well said.
Awesome. Well, all right, let's get serious here. You are coming to us near the Windy City. Is that correct?
That's exactly right. Yeah, it's still a little breezy where I am. We're about an hour west of Chicago downtown, due west, actually. Mm-hmm. And we lived downtown Chicago for 11 years and loved every minute of it, but it was time to move on. And thank goodness, we've got a great team here helping me, and we work with clients in all 50 states, a little over 1,600 clients across the country, and we love every one of them.
Awesome. Let's jump into that a little bit, Mark. Now, you're a certified financial planner, and there's some different classifications when we're talking about financial planning. You're a certified financial planner and a 3-time best-selling author, by the way. Congratulations. I know that journey as well, so that's fun. But what inspired you to create a financial system that challenges traditional wealth-building strategies?
The honest answer is I was sick and tired of seeing it in my own financial life, and sick and tired of seeing it impacting the clients that I was working with. Short answer, slightly longer answer. I believe that there are at least 4 flat tires on your financial vehicle, which means we're not moving very far, very fast. If you've got a traditional financial vehicle, like a 401k, an IRA, this would include your self-directeds in a lot of cases as well. Here they are in rapid succession. Number one, fees typically are gobbling up a large portion of your nest egg. Even a low-cost IRA, 401k that you might have through hospital, through employee system, and that would include your 403bs and so forth as well. A fee of just 1%, which you add up the 12b1 costs or the wrap account fees or the just mutual fund fees or the advisor's fees, 1% total aggregate fee. Doesn't sound like a lot, but over a 35-year retirement, that's 27% of your nest egg, according to the Department of Labor. 27%. Mm-hmm. Number two, market volatility and asset volatility destroys compounding. It's literally impossible to compound your wealth when markets or other investments, stocks, real estate, whatever, can go up and down. And so it's impossible to compound. It's like trying to see an airplane take off the run, do that J-curve runway liftoff while the pilot constantly is hitting the brakes. It's just not going to ever lift off the ground. So that's the second, is breaking compound growth every time markets have a hiccup or a hissy fit. Number three, we have no idea what future taxation will be. And most of our qualified plans, IRAs, 401ks, 403bs, are tax-deferred vehicles, which is great when you're a high-income earner to lower your taxes today. But it's sort of like jumping out of the frying pan into the fire if you believe taxes are going up in the future.
Or if you believe you're going to make less in the future too.
Yeah, right, exactly. And then the final last one is, well, how long are we going to live? How long do we need this retirement money to last for us? Most people, if they're honest with themselves, have no clue how much they need to take out of that IRA or 401k or 403b or whatever to make sure that they don't run out of money before they run out of birthday candles. Mm-hmm. So those 4 flat tires, I think, are non-starters. They're deal breakers for most. And we have folks with $30+ trillion in typical, oh-so average financial plans. And it's going to end up with most people, well, it's already hitting the retirement skids. There's a crisis in this country. Most people have no other alternatives. They don't know, like some of the things you talked about on your show or some of the things we specialize in on our podcast and at our financial firm. But folks need to know more about some alternatives to the traditional flat tires of 401ks and IRAs.
Yeah. What's the name of your podcast?
It's a Not Your Average Financial Podcast.
Not Your Average Financial Podcast.
Yeah, we kept the title real short, you know.
Yeah. .com. Anybody out there who's created a business and a website, those journeys of getting the perfect URL and then the realization that, oh no, what did I just do to this email I just created because of my URL?
Totally.
.com.
Yeah, exactly.
Yeah. So, hey, what's the biggest misconception people have about building wealth?
Most of it is simply just that we are investing when we should be saving. Most people think that, oh yeah, if I just throw my money in growth stock, mutual funds or long-term invested, held to maturity bonds or whatever, or an index fund or a target date fund, that they'll be fine. The real investor returns are far less than what are advertised. It's like the difference between what you see on the billboard outside the McDonald's and what you get in your takeaway sack. It's a very different experience. The returns that people promise you versus what you actually get. Case in point, let's say for fun that, Brett, you put $10,000 in some stock and up it goes. It goes up. In fact, it goes up 100%. Your $10,000 mathematically would now be $20,000, right? You doubled the money in 1 year. Not bad. So now you're happy with the investment. You stick with it. So now your $20,000 is invested. Unfortunately, in year 2, you lost 50% of your money. So your 20,000 goes right back down to where you started, $10,000. So you had a negative 50% return. So guinea pig with me on this one, Brett, really quick. Do you feel any wealthier 2 years later?
No, I feel like there's wasted time.
Wasted time. Yeah, you earned a lot on paper, you lost a lot on paper, but you weren't any wealthier at the end of the 2 years except for the lost time. But did you know, if we just did the math there, 100 minus 50 divided by 2 years is a 25% average rate of return.
Come again?
100% rate of return in year 1 minus 50% in year 2, okay, divided by 2 years, the length of time, that gets us our average rate of return. So what's 50 divided by 2 years? 25%. Your average rate of return in that little story example was a 25% average rate of return. Shouldn't you be happy with an average rate of return of 25%, Brett?
Makes me think like I can draw a line from point A to point B straight, or I can draw it squiggly. Which one do you prefer? Yeah.
Well, and take just mentally look at the stock market in your mind. Is it a straight line or is it a squiggly line? Mm-hmm. The problem with compounding is it's impossible to do when there's a squiggly line. There's the difference between the internal rate of return, which was 0, and the average rate of return, which was 25%. However, the stock market, the Securities Exchange Commission, and every financial advisor in in the world really is legal, at least in this country, is legally allowed to advertise an average rate of return.
Shame. I'm pointing the finger for the listeners. Shame on them.
So what was the real return? And why does it matter? Well, I think the real return, by the way, was, this is going to shock you, but according to third-party research firm Dalbar, Dalbar, real investor returns over 30 years was closer to 3.6%.
Oh, wow.
Even though the stock market was doing 9.9%. So that to me is crazy. But why does this matter? And I agree with you on the shame piece, by the way. It's going to make people be less prepared for retirement. They are going to expect one thing. That Big Mac looks so good on the menu, and then when they get it in their bag, their takeaway bag, it's going to be underwhelming, and they're going to be 70 years old and not have much more time to do much about it.
Yeah. So what in the world are we supposed to do? Let's talk about this then. Mark, what is this bank on yourself, and how is it different from traditional banking and investing? Is it related to the scenario you just explained?
Well, it really flips on its head the idea that we're supposed to outsource this money thing to somebody else. The philosophy of bank on yourself means don't bank on somebody else to be your money guru for you, to in-house your financial life. And in particular, I'd say the biggest lever we can pull in our financial life is not, hey, how can we swing for the fences and get a slightly higher rate of return on this or that mutual fund? The biggest lever that can do the most good in our financial life, in my opinion, is to recapture and to bring back in-house the banking function in our life. You think about it, how many cars are we going to buy over our lifetime? How many rental properties? How many syndication deals? How many fix and flips might we do as a result of getting into the real estate space? How many dollars are we going to spend sending our kids to school? Or even just paying off our own medical student loan debts. These things are not cheap. Sometimes, I talked to two dentists and they had $750,000 combined student loan debt.
Yeah.
So they could just spend that money and just pour money down into the hole that they had created. And now they're 8 years older and they have nothing to show for their money, for example. Or they could buy a bunch of real estate. Now it's sunk into the cement of their properties that they bought. And they hope that they can get that money back when they sell their properties. And there's some incredible power to real estate. And I have it in my portfolio. I encourage our clients to have it. But Bank on Yourself uses a dividend-paying whole life insurance chassis to essentially create a wealth pool for your rest of your financial life. It allows you to pour money into the policy where it grows on a contractually guaranteed basis. And you have liquid access to that money. Liquid meaning accessible now, today, not when you're 60 years old, 70 years old, whatever. And that money, if it's designed properly, can be accessed with no taxes due. And maybe most importantly, if it's designed properly, and again, so many people are out there talking about this strategy, but if it's not designed properly from someone who's been certified, again, it's a lot like the certification process to become a certified financial planner. The Bank on Yourself designed policies have a quality control standard here to make sure that the thing was designed properly. But if it was, and you were to say borrow against the life insurance cash value, the policy will continue to grow and earn interest even on the capital you borrowed, such as if you had never touched the money. Now that maybe bears repeating very quickly with a quick example, and then I'll be done. Let's say that you had $200,000 in cash value. In fact, I'll even use a guy's example. This gentleman had $750,000 in cash value, and he borrowed against his policy to invest in several pieces of real estate. The policy continued to grow and now still earns the same dividend he would have otherwise received had he never touched the money. And of course, he also has the real estate deals as well.
So on the payback, then, when we're paying these loans back to ourselves, that the reason why it's still gaining because you actually pay yourself interest. Is that correct?
I'll say it's slightly different. And there's a little bit of misconception out there. And again, there's probably a 1,000 different YouTube channels with folks that just got their life insurance license last Tuesday talking about this. So please be sure that you work with someone who's been authorized by Bank on Yourself. It's the only credentialing program in the industry that I'm aware of. So to answer your question, you're not technically paying yourself interest. Essentially, it's a lot like a HELOC on a house. When you borrow against your cash value, you're getting that money from the insurance company. And this is a company that you are a co-owner in. So it'd be sort of like saying, let's say you and me go into the mortgage business together. You and I own a mortgage company. And let's say, Brett, that I need a loan for my new rental that I want to buy. Am I going to go to any other bank to get my mortgage, or am I coming to you and me? Hopefully I'm coming to you, right? I'm coming to our company. And when I borrow money from our mortgage company, Brett, as a co-owner with me in the business, are you going to want me to repay that loan?
Yes.
Good. That means we're staying in business.
Yeah.
And as I pay back that loan to the company that you and I own together, who financially benefits?
Both of us.
Both of us do. Yeah, exactly. This is how it works with mutually owned life insurance companies. I borrow the money. They use my cash value as collateral. I repay the loan to the insurance company that I co-own with everybody else. And it's a part of the overall, it's called non-recognized or non-direct recognition policy loans, where my money is still earning full cash value growth and dividends. And even as I've got access to that money for my other investments and opportunities.
And in those policies, not to get too far into there, but do I have to make the annual interest payment on that money? And then I can have it out as long as I want?
Yeah, there's no required repayment plan in your lifetime at all. If you want to take 6 months or 6 years or 60 years to pay back the loan, you're the one that gets to drive that ship. You're the banker here in this case. In fact, there is interest that's accumulated when you borrow from the loans. Of course, it's a real loan. That's why, by the way, you can get the money without taxes due, because loans are not considered income by the IRS, which is so cool. It's a genius move. But if you never pay off the loan, it's just deducted from your very large death benefit when you pass away.
Yeah. Now, I've heard you say that there's something better than being debt-free. What do you mean by that?
Yeah, this is for those people that love paying cash for things. I tried to be one of them for a long time. I listened to the Dave Ramseys of the world and that sort of thing. Until I realized that paying cash was not the answer. If you really stop and think about it, you finance every single thing you buy. Either you pay interest to a banker, like a car loan or a credit card or a mortgage, or you save up and pay cash and you pass up the interest you could have earned on the money had you left that money in your bank account or brokerage account and left it to invest and grow instead. So we're either paying interest to the banker for past purchases, or we're stealing interest from our future selves. We're financing it from our future. Like a $50,000 vehicle today might be $200,000 of lost opportunity cost by the time I'm 65 or 70, depending on rates of return and all that. That's a that's a tragedy. If you think about how many stinking cars we're going to buy in our lifetime. So to answer your question, what's better than debt-free? What's better than paying cash? Well, in my opinion, using the policy allows me to become better than debt-free. It's now continuing to grow, that uninterrupted compound rate. It's a straight line. It's a linear projection of growth, which becomes a J curve over time, since there's no volatility. There's no up and down, no beta to the rates of return of whole life insurance. It's just more and more and more efficient every single year we keep the policy. Meanwhile, I still need to buy stuff. I still need to live. I want to buy my cars, go on vacation, and invest and send my kids to college. So by using my cash value as collateral for loans against the policy, it allows me to become better than debt-free. As I repay myself, I'm now better off than I was when I started, not just getting back to square one.
So on something like that, like a depreciating asset, I would say if you're going to take a HELOC, never buy a depreciating asset with a HELOC. Right. But in my mind, I'm hearing you say, okay, if I'm going to take a loan out on a car, what if I use the policy and then I pay the policy back instead of pay the bank back?
Yeah.
Is that what you're saying?
Yeah, absolutely. That's right. Hey, don't go out and buy cars you don't need anyway, but if we're going to get that car anyway, what's the better way to do it? I can't find a better way.
Yeah. Now, I did see a $3.5 million Conus egg on Saturday here in Charlotte. So, I mean, if we got that cash value in
That's
the
right,
policy, man. Let's go. Let's rock and roll. I don't want to get too far into that piece, but just the idea of, say, that scenario, the 750,000, how long would it take to get a cash value like that?
Well, in this guy's case, it took him about 9 years, but it could be in the first 30 days. If you had that kind of money sitting in your savings account, you could dump that money into your policy. And depending on how we structure the policy, most or all of it would be liquid and accessible within about 2 to 3 to 4 weeks at the most. As far as that check clearing, you can access the money usually within about 5 to 7 business days after the policy clears.
Interesting. Now, on this idea of using this in a financing way and relating it to real estate, what do you think is the biggest financing mistake that real estate investors make, and how can they avoid it?
You probably would have some ideas on this too, Brett, so feel free to tag on and add to this one. But, a lot of people, I think, try to swing for the lowest interest rate, and that's fair and that's fine. But, you guys, you're doctors. You understand that when I put an injection into somebody for a medicine or a vaccine or something, it's not the rate that saves me or kills me. It's the volume that really matters, right? It's the volume that matters. So how much medicine's going into my body is going to be the determining factor of whether I heal my body or it still fights the disease, whatever it is. The same is true with interest. It's not the interest rate that matters. It's the volume. And I had a guy who was a doctor making good income, and he had great rates of return on his mutual funds. He had done very well for himself. And yet all of his mortgages and everything were all low interest rates. And yet a third of his income, the volume of his money going to interest was 30+%. So it's the volume that was killing him. He could not, even with the mutual funds doing 10+%, he could not overcome the volume that was going out the door. And he kept saying, Mark, I feel like I'm a slave. A third of my day I'm working for the bank, and another quarter to a third I'm working.
And let's
for
throw the taxes in there, Mark.
Yeah, that's right. Uncle Sam was another third there.
Yeah.
So yeah, he felt like even as he ran his own medical practice, he was, hardly working for himself.
Interesting, the volume. And then in that scenario, my mind goes instantly to if he was leaning on a mutual fund, the volume of the mutual fund was nowhere near the volume of the mortgage.
That's right. Right. Yeah. That's why I could say I could give you a 0% rate of return and still beat somebody else who was getting 10% rate of return on his index funds or whatever. Yeah. It's all in the volume of your saving.
Yep. Volume. There's so much more. I know we're kind of pinned on our schedules here today. But where can the listeners go to find out more or connect with you? Because I like this bank on yourself idea. I like the idea of creating that life insurance piece. And let's get serious. The big boys do it. The big companies, they insure all of their employees, their key leaders, board leaders, whatever it may be. When I've always heard, and then there's this whole thing about captive insurance, when you run out of things to invest into, start an insurance company. And that's where the big money goes. But if we have mechanisms to leverage that ourselves, let's do it. How can we connect with you?
Man, that's so true. You're right. I was just reading that Bank of America, just as one case in point, they own more cash value life insurance than all of their real estate combined. Just as one simple example. Corporations too, some of the biggest purchasers of these are major, global corporations. So if it's good enough for them, it's good enough for us. I'd be, really happy to speak with you, with anyone who's listening, as someone who's interested in finding out more if this is a good fit. It's one of several dozen strategies that we specialize in at our firm. One other one we didn't get a chance to talk about today is the best rental property you've never heard of. And it's a contract that's been around for 2,000 plus years. So we can talk about that if folks are interested. So again, you can go to kickstartwithmark.com. That's kickstartwithmark.com. And also while I'm at it, man, everybody leave Brett a 5-star review. His show is a lot of fun and he's doing a lot of good for folks in the medical field all around the world. So Brett, thank you for the work you do.
That's awesome, man. I really appreciate that shout out there. And we have to have you come back and talk about this rental thing that we should know about, because if it has anything to do or similar value that the insurance piece has, there's got to be a lot of value there. So, Mark, awesome. Thank you so much. One last little question. What's one thing that you would have loved to have done 15 years ago?
Oh man. Well, that's in any arena, any area of my life.
Anything.
Yeah, man. Well, we got about 90% up the way to Mount Fuji. We almost got to the summit, and the weather was so bad, all the guides were telling us to turn around. I want to get that last 10%, so I got to find my way back there.
That's awesome. Well, good luck and be safe. I will not be there with you. That's the one thing I will not be doing. But everybody, right. This is kickstartwithmark.com. Find out more about Mark and his firm, what they're doing to change your world, change your life. And it all starts with an idea. And then that idea turns into connecting with the right people. So thanks again, Mark.
Thank you.
Man, I always love these conversations just because it's one of those topics that you've probably heard about. And it just keeps you wondering, what now? What now? I know it's out there. I know the big time investors are using this. The big companies are using this. It's time to take action on this. It was an eye-opening conversation. Here are 3 things that I threw in the bucket today. Traditional financial plans, which are 401ks and IRAs, have built-in limitations that can hurt your long-term wealth. The bank on yourself strategy allows you to become your own banker and keep more control of your money. It's not about chasing high returns. It's about reducing risk and maximizing financial freedom. To learn more, visit kickstartwithmark.com and book a strategy call. It's worth the call. Learn more about the system. You've probably heard a little bit about it. It's time to take action. Thank you for taking action today and listening to the Real Estate Mogul MD.